Okie doke, good afternoon everyone and welcome to this first afternoon session on closing the gaps. It's great that you're all here. I hope you enjoyed the morning session. My name is Beglinger. I'm the president of the Swisscleantech Business Association. I'm Swiss. I deal a lot with issues like infrastructure finance. I'm also an advisor to the UBS Clean Infrastructure Fund, the first fund focused on clean infrastructure in Switzerland. I'm here in my role as a board member of the Global Infrastructure Basel Foundation, and I'll be moderating a very high-profile panel today. I thank everybody who is on the panel already as a start. We have an interesting topic, and the topic is the early stage, greenfield stage of infrastructure projects. The aim of the session is that we discuss quite specifically where the problems are in today's environment. Why do we have not sufficient projects on the one side and lots of cash on the other side? How can we make the two meet? And as was already profiled this morning briefly, the core is really the early stage. And it's therefore a very important session, and we try to get at very specific results. So that would be my first message to all the panelists, if you may. We don't want to discuss about general things. We'd like to boil down to the issues we're here amongst us, so we should have an open discussion. And after each panelist, who will get a 5-minute window to give a brief overview of the person he or she is, the organization he or she works for, and then a view on the topic in general. I will then ask some questions, and I will then open the floor for all of you to ask some questions as well. We'll keep that pretty short in the first round and go to the second and the third and so on. And at the end, we're going to touch upon the key issues again, and I would like you to participate as well. So make it an open and interactive session in this huge U-shaped thing that we have here. You seem so far away, but don't feel it. So with this, I'd like to actually introduce our first panelist. His name is Giridhar Srinivasan. Almost got that right. Giridhar represents a very established organization, the IFC. Giridhar, please give us your input. Yes, there's a microphone here, and there's one for yourself.
Hi, I'm Giridhar Srinivasan. I expect many more of you will be able to pronounce that after you've had some wine this evening. Thank you to Daniel and everybody else for inviting me. I'm very happy to be a part of this panel. IFC is the debt and equity investment arm of the World Bank. We engage in advisory services for governments. We also invest in emerging markets around the world. We recently raised a large co-investment platform from sovereign wealth funds and pension funds to invest alongside IFC in transactions. As far as infrastructure goes, our current portfolio stands at over $10 billion. Our track record is very good. Our NPLs, non-performing loan rate, is less than 3%. And our equity investment track record over a very long time is around 20% in infrastructure. So we're able to go to some tough markets. We do have some immunities and privileges, but we're able to go and bring the private sector to these markets. Infrastructure is increasingly the largest focus for IFC. We recognize that this is a priority area for us. So Jaime Caruana and others have said there's a problem with the lack of bankable deals in the market, and I think we have a solution. So for the past, so we all understand, so I'll go out and not so humbly say that. The problem, as we know, is there's sort of two classes of people running around. There are the developers who are running around with project ideas, and on the other hand, you have financing available at the much later stage. But every lender wants to see a well-structured, fully permitted, ready project. Only then they come in. Every time a developer tries to go to them earlier on, they say, no, 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 the project is not ready. And they don't want to engage. The lender doesn't want to engage to go and make a deal bankable, because all they can make is their fee, the lender's fee, which is 1–2% of project costs, whatever the market may be right now. So the question is, how do we cross the chasm? How do we go from developers who have all these ideas where project development is reasonably risky, there's a high rate of failure, and get them to access the financing later on. Well, there's two sets of barriers. There's the barriers on the government side, which are the regulatory issues, and then there's barriers on the developer side. So as far as regulatory issues are concerned, colleagues from the IDB and many other multilaterals and governments are working hard to try to improve the regulatory environment. But we should all assume that takes some time. It's nothing that most of the people in this room can do anything about, unless you're from the government. So the question is, what can we do? And what I would argue, and what we are doing right now, and I'll discuss that, is we need to look at other industries which have successfully incubated developers or entrepreneurs and help them access mainstream financing. Let's look at Silicon Valley and the venture capital sector. We basically need, what we need is we need venture capital for developers. That's what we need. We need a way to take their project ideas and bring them to financial close. So can this work in a heavily regulated sector? Absolutely. Venture capital is focused primarily on technology and pharmaceuticals. Pharmaceuticals, of course, drug development and discovery is heavily regulated throughout the world. So what did we do? We were struggling with the problem for several years of having more capital, not having enough access to bankable deals. So 6 years ago, we created a project development fund called InfraVentures. And what we do is we come in at that early stage when the project is still under development, and as opposed to saying this project is not yet ready for us to engage, we invest equity in that particular project, work alongside the developer, and then accelerate the project and bring it to financial close. I can go into some detail about this, but we've done, the fund is a $150 million fund. We have invested in 27 projects around the world. All of them are in IDA countries, although increasingly we're moving to non-IDA countries. We have had 3 successful financial closes so far. 185 megawatt hydropower project in the Republic of Georgia, where we were initially partnered with a small Norwegian developer, and we brought in Tata Power of India. The second project is a thermal power project with Bottleneck in Senegal called Toben. And the third is a water investment in Haiti called De l'eau Haiti. And here's what we're doing. So if you think about, let's think about this financing gap for a second, and what specifically, to answer the next question, what is specifically the problem? So a developer, project development takes about 3 to 5 years. Right? Typically, any medium-sized project, not ultra-complex project, takes 3 to 5 years to go from inception to financial close. Construction may then take you 1 to 3 years after that. So if you look at what a developer is spending time on, they're spending about 40, even 60% of their time just raising money. And there's a high risk of failure. They have, if they're lucky, 1 in 3, more likely 1 in 4 or 1 out of 5 projects are getting to financial close. So, and they're always cash constrained. Because they're cash constrained, here's the problem that they specifically run into. Let's say, they're responsible for permitting, getting licenses, signing offtake agreements, resettlement studies, everything that you need to do to structure the project and bring it to financial close. And of course, raising the financing. So if you go to a developer and tell them, you need to go and do the resettlement study for this hydropower project right now, they'll delay it because they think they don't have a clear enough view as to whether or not the project is likely to reach financial close. And because of that, you end up with this problem where the government, on the other hand, is saying, well, this project is not really going to get anywhere, so I'm not going to go and work too hard with you. So you get stuck in this downward spiral where the developer will make an incremental step and then try to convince everyone that everything is done, but it's not yet done, and that's transparent to everyone, especially to the lenders. So what they need is they need cash, and they need someone who can guide them along the critical path and play that supporting role, just like a venture capitalist does for a technology company, for a technology startup. So I'll stop there, but we can talk more about our risk management approach and our portfolio approach.
We'll get to that in a minute. Thanks a lot. Very, very interesting. If you keep the micro for a second, you're going to just go through some questions. So InfraVentures is basically your solution, right?
InfraVentures on the developer side, yeah.
On the developer side, that's the solutions. Could you tell us a little bit more about that? 150 million average deal size would be? So this is a very important distinction. We spend anywhere from $2 to $8 million on the project. But remember,
the upfront development cost is a very small fraction of the total project cost. So to
how much would that typically be, upfront versus total project?
Sure. So let's say you take a 50 megawatt, just argument's sake, 50 megawatt hydropower project. Your capital cost might be around $100 million, right?
Yep.
The project development cost could be, you know, in a more mature market, less complex project, say $3 million, up to $8 or $9 million. Assume on average your project development costs in an emerging market are about 5% of the capex.
So 3 to 5 upfront, that the rest comes much later, different ball game. We're really talking about the 3 to 5% at the beginning.
That's where they get stuck.
And you, with your 150 million on infra ventures, you're only looking at those 3 to 5%. None of that money goes to later stage. It's all for early stage.
So what we do is, out of the $5 million, the developer might put in 3.
Yep.
We put in 2, right? And now we have the option to subscribe to 40% of the equity at financial close,
yep.
right? And so the rest, the other monies can come from IFC's balance sheet.
But the fund's actual business model includes the upfront finance for the early stage costs and some of the rewards from later stage.
Absolutely.
Would you exit immediately once another investor comes in late stage, or would you keep and then sell?
We've done it both ways. We prefer to stay in.
We prefer to stay in?
Yeah, we prefer to stay in.
And I asked you on the phone, preparing this panel quickly, if you don't mind sharing it with us here, on average, what are you expecting? So you're putting, let's call it 3 or 4 million. How much you expect in a successful project to come out, and how many projects of all do you expect to be successful?
So the key thing here in managing the portfolio is not to go and blow $3 or $4 million on a failure, but rather it's to only spend $200,000, $300,000 on a failure. And typically with projects, if it's going to fail, you know it's going to fail in the first 18 months before you've spent too much money.
You smell it.
You know it, because you know what? You go to a government, this is the thing, this is the difference why I would actually argue this method, venture capital for infrastructure, is less risky than venture capital in Silicon Valley. In Silicon Valley, I can create, I don't know, bookface.com, and I can do a million things with that website, right? With this, it's a critical path. If you don't get your generation license from this country, you're not going to get a power purchase agreement. If you don't get a power purchase agreement, no EPC is going to really sign up to build this thing at the end of the day. It's a critical path. It's a stage-gated process. So to answer your question, we put in, say, we'll try to commit the full $4 million for the project, for the successful projects, and we kill the losers very early on.
Okay. Now we're going to move on. Very, very qualified points. Obviously, snack on to the solution with infra ventures. I have one follow-up before we move on. Where do the 150 million come from? Is it only IFC's money, or is there any other money involved?
For now, it's only IFC's money. But I would argue that if you are a government, if you are a pension fund, if you are an infrastructure investor with a lot of capital sitting around, not able to deploy it, you're not able to deploy it, having a project co-development arm like this alongside what you do can accelerate project development.
IFC have money to spend into other funds that are setting up in the same way?
That would come from separate pockets.
Separate pockets. Okay, Giridhar, thank you very much. That was a great first input. So I'd like to open up briefly. Does anybody have a question that is for Giridhar? Probably take the mic back.
Go ahead and we'll take the question.
Exactly. If you don't mind, I've asked a few questions. We go ahead and you can get to him in the second round, okay? So our next person is also very, very qualified in this area. Gaston Astesiano is a senior advisor for infrastructure and environment, also at a multilateral agency. Over to you. Thanks a lot.
Thank you very much. I'm Gaston Astesiano. I work in the Infrastructure and Environment Department of the Inter-American Development Bank. Differently from the IFC, we only work in Latin America, from Mexico to the south. We have in our group both the private sector and the public sector side in the same bank. We are not separated like the World Bank and the IFC. That gives us some advantages and some disadvantages. One of the advantages is very closely related to the topic we are trying to address today, which is the early stage financing. In our department, we have several dedicated funds for project preparation. I don't know if you are aware, Latin America is the region in the world that invests the least in infrastructure. It was at the level of South Asia in the 60s, and now the gap is enormous. Mainly the lack of or the structural adjustment programs in the 80s and 90s, with the hope that the private sector will tap in and investment, generated this gap. Nowadays, the region invests roughly 2 to 2.5% of the GDP of the region in infrastructure, and if it were to catch up with the Southeast Asia, we'll need to invest roughly 5% of the GDP of the region. This, in absolute numbers, will go from 125 billion to 250 billion in infrastructure. And if we are talking about 3 and 5%, that's the number we also have for project preparation. We are talking between 7 and 12 billion in the 5% scenario, or 3 to 6 billion in the business as usual scenario. To give you a ballpark idea, the IDB sustainable level of lending is $12 billion, of which probably 50% goes to infrastructure, both with sovereign guarantee and without sovereign guarantee.
That's 15.
Yeah.
Yeah.
And so we are, and the World Bank has a similar envelope for the region, a little bit smaller probably. There are other big players coming in. Banco Nacional de Desenvolvimento Econômico y Social, the Development Bank of Brazil. It's actually much bigger than us, and the World Bank is roughly $100 billion lending a year, and it's becoming a regional player and probably soon a global player, like the Chinese. The Chinese are very active also in bilateral financing, mostly in natural resources. So we have had a kind of a severe crisis between a lot of financing interest for projects, and they are not ready to move forward. We have started what we call the Infra Fund in 2006 as a way to try to bridge this gap. This is a fund for project preparation, and beneficiaries can be both governments and private sector sponsors. And it has a maximum support of $1.5 million per project. It has been focusing mostly in projects that are probably not at the very early stage, but closer to the financial closure, because that's where the projects, the ready-to-go projects are, and where we will have a quicker win in using those resources. And kind of connecting with one of the questions, one of the very first projects of this fund was to create a fund for project preparation in Brazil. Brazil just approved the PPP laws in 2004, and we joined forces with the IFC and with BNDES, the Brazilian Development Bank, and we created a facility for project preparation. We put $1 million. IFC started with $1 million, and BNDES with 1.9 million. For a regulatory issue, was better not to have BNDES have a greater share than the half of the project, and we have been successful in disbursing that money. This fund has a committee with the IFC, BNDES, and IADB, but is run on everyday basis by the IFC. They are the trustee of the fund in Rio de Janeiro. Today we already have disbursed second commitments, so we are roughly on $8 million in the fund. We have funded 5 projects for roughly $1 billion in Brazil. We are not funding the entire early stage, but mostly focusing on the financial closure or technical advisory. We are recuperating success fees from the projects that are reach financial closure. One of the interesting features we have in the infra fund, the fund at the IDB, is that we grant to the private sector in what we call contingent recovery. So the sponsor will only be obliged to pay back to the fund if the project reaches financial closure and the IDB does not finance the project, either through the sovereign guarantee or non-sovereign guarantee, or granting a guarantee in the case which is another product we can support the infrastructure projects. Mm-hmm. As of today, we have we have, just to sum up, because I see that we are running out of time,
Yep.
we have other funds for infrastructure. We have an renewable energy fund, an aqua fund for water and sanitation, and one especially dedicated for infrastructure for integration. But they are managed all together. I coordinate them under the infrastructure department for both private sector and public sector. And we try to optimize the use of those funds. We don't suffer from the silos problem that Africa has in using those funds. And we think it's a good vehicle. It does not solve all the problems of early stage. We are now trying to develop a vehicle for a very early stage, same approach of infraventure. Very beginning. It wouldn't be equity because we cannot do equity from the IDB, but we are on the process of changing our bylaw and be able to do that.
You are changing the bylaws to take equity and then be able to take a fund like.
We have a mandate from our governors into spin off our private sector practice into a different organization. Which will be able to do equity.
Okie doke. I'll open after one of my questions to the floor, so please make yourselves known if you have questions. Quickly from my side, your average sponsor or the party you're financing, could you describe that organization? Is that, a Siemens, GE, big multinational, or are there smaller outfits? How does one have to imagine that?
We have actually a big variety. We have some of the big multilaterals, but we also have local developers. We work a lot in small scale hydro or wind farms, and so you have local developers. And we also have an initiative that is called Opportunities for the Majority that finance very small, up to 5 million projects. We have done a very successful project, is the structuring of Sala Uno. It's a group in Mexico that gives eye doctor and eye testing for lower income people. We have structured the facilities fielding and the business plan through one of our infrastructure funds.
Very interesting. Thanks, Gaston. Does anybody have a question for Gaston right now? Raise your hand. Got 3 seconds. No, that's not the case. We're moving on to our third panelist. I take the pleasure in introducing Kostis Tselenis. Kostis is the head of investment at Quadia Impact Finance. Kostis, the floor is yours if you would take this micro.
So where we're focusing on is social and environmental investments. We're an active investor, but we do represent high net worth individuals, family offices, wealth managers, and private investors in general that want to have a social environmental exposure. For us, infrastructure is number one in terms of being able to create economic development locally. And we know that economic development can then trigger a positive effect on education, health, poverty alleviation, etc. So infrastructure is number one for us, a focus as well. Where we believe that there is a great potential today is with small-scale energy generation infrastructure. One of our largest investments is in the field. It's called KKB Energy. We have the pleasure of having the CEO, Mr. Miyu, here in the audience today.
The guy on the right there.
Exactly.
Raise your hand.
So make sure you follow up with them. It's a very interesting story, a very great company, and we're very happy with our investment. We want to focus and highlight the advantages that this area has. We have been hearing before about large infrastructure projects, absolutely necessary, and at the same time and in parallel, we believe that we should trigger the small-scale infrastructure as well. If it's energy or not, this is not very important, but the reason for that is we want to have more, and we want to also be able to pipeline more funds in this direction. And in order to pipeline more funds, we need to identify where the funds are going to come from. We're talking about a bottleneck. There is a financing bottleneck in the segment. Where should the money come from? What we can give you a little bit more input on is on the private investor world, which we're also representing. We've been here in the international organizations that definitely have a very important role in facilitating the start of such projects. And eventually, on a later stage, we should bring in more financial investors, private investors, that want to be exposed in the segment, but in most of the cases they cannot. Imagine a private investor that would like to have an exposure in the segment would be challenged on doing direct investments, would be challenged on being involved in a project. First, because of the size. Usually the amounts are smaller, and therefore they cannot take substantial positions into an individual infrastructure project. And secondly, because the risk profiles are very different. So the question here is, how can we get a very large pool of private investor money into the infrastructure world? One of the solutions are infrastructure funds, as we have seen before. Another solution is companies like KKB Energy. But even then, in most of the cases, we still need the facilitators, which are the international organizations again, and institutional investors that can take the risks, the upfront risks of the pre-development phase, in order to be able to offer something with a lower risk profile to such investors. The pools, the amounts that can be pipelined are enormous. Usually these kind of private investors are burning their fingers with the one or the other infrastructure project, and I have to admit also with the one or the other infrastructure fund. If we're talking, you mentioned before, usually such funds can start with 8 million. The question is, how many projects can we do with 8 million? Very few in energy infrastructure, and therefore the diversification effect that a private agnostic investor would expect is not there yet. With 150 million seed financing from IFC, yes, this is already a level where a private investor would say, yes, I could get involved in the second stage, or even in the early stage, but if a very well diversified, very well managed fund with all the aspects in terms of governance, etc., being completely solved. So this is what we want to highlight here. One other solution that we believe would probably bring the market a little bit, the industry a little bit forward, would be the matchmaking mechanisms between risk-return profiles from the private investor world and the individual projects, if we would still remain in the direct investment world. And okay. The last thing that I want to say is, throughout the value chain, we're talking about early infrastructure, yes, but these developers, even if they're well financed, they will not be able to keep these projects for very long on their balance sheets. We have been seeing that has been happening while there was little debt financing in the last 5-6 years because of the crisis. The developers were able, some of them, to get funding and therefore acquire the projects, put them on the balance sheet, and then they cannot keep them very long. They need to have that revolving mechanism within their structures to be able to do more early stage projects. What we need there is the ones that are going to acquire the projects, the fully installed and operating. Therefore, it's the second step of the value chain where we also need to fund it separately.
Mm-hmm. Thank you very much. Interesting. Can I just clarify a little bit on the background of your investor? So if I'm a private individual, I have enough cash to give some to you to manage, what would you tell me my expectations should be? I mean, in terms of return, in terms of period, I have the money with you, what sort of, on average, would be my, what would you tell me? Because you were speaking about social, environmental exposure and impact investment, and usually that sounds like a lot of risk and little return. So what would it be?
We believe that when you address environmental and social aspects for an investment, you're actually reducing your risk exposure, because the very company, even if it's venture capital or it's a project finance, they're in more coherence with environment and with the local community, therefore per definition lower risks. Mm-hmm. Our investors are coming to us specifically because of that social impact footprint, mm-hmm. that environmental footprint that the investments have, mm-hmm. And they have extremely diverse expectations in terms of risk return profiles, industries and geographies. So usually, and this is where I was talking before about the matching mechanism. It's a lot of money that can be pipelined from this audience, from this investor group, but it's also very difficult to map them in one vehicle because the return expectations are different, geography expectations are different, and that's a little bit challenging for us as well, to mm-hmm. create portfolios that are well diversified and at the same time address the special preferences of each high net worth individual or investor.
Thanks a lot. Is there a question from the audience on Kostis? Some more background needed, or is all clear? If that's the case, anybody? Was that somebody? No? Then we're going to move on to our fourth panelist. Thank you very much, Kostis. Our fourth panelist takes a different view. Bas, I got to check your last name, Oomens, right? Bas is working with Pöyry Energy. Pöyry is a very established engineering firm, and he looks at the early stage investment from another side. Bas.
Yeah. Thank you very much, Nick. Yeah, I'd like to give you or share with you an example from the daily practice. We hear a lot about we should invest more in renewable energies, and I like to sketch an issue in a technology which is geothermal, where we clearly observe a gap in financing which is related to the risks. Now, maybe to sketch a little bit of background, geothermal projects differ from other projects such as conventional thermal power generation projects, in the sense that the first phases of such a project are more related to the oil and gas industry, and the later it isn't up to the later phase where you start building the above ground plant, where you enter the phase which is more similar to what we know from gas, oil, coal plants, or wind or hydro. Now, if you stage the project, first you would say you go for your preliminary investigation, the surface, then the exploration phase, you do the seismic data collection, and then you go to a critical point, which are the test drillings. And it isn't up to that point that we know everything about what is underground. So you need to do a test drilling to know what is the amount of energy, what is the money which is actually in the ground. So we get here to the bottleneck, because on one hand we need to do this work to find out what is the money which can be generated afterwards, and on the other hand we're facing here a phase where the investments are rather high. Typically for a test drilling you talk about 10–15% of the total investment cost, which are then followed up in the next stage by the exploration of the field, where you start drilling more boreholes, and the total cost for typically for a power plant are, let's say, 40 up to 60%. So the question is here, and that's what I probably like to discuss with you, is now what's going to be the role of the private party and what of the public? What we observe after the economic crisis in 2008 is that the developers have much more to prove what is the energy content of the geothermal source, to have the money to later on to construct the power plant. And the question is thus, who is responsible for bringing the money, or who can bring the money, and who's responsible for reducing the risks? Risks, you have here to think about the technological risks, the availability of good geological data, and on the other hand, these risks can be enhanced by the local regulations. As example, in certain countries, as developer, you're obliged to develop a plant for power and heat. Now, to explore a field for power, and for example in Europe, you would have to drill much deeper. Deeper drillings are related to higher costs, higher risks. And we have seen it last week in Switzerland, where a project was put on hold, or stopped even, because they found out by the first drilling that the amount of energy got out of the ground was too little to build a power plant. And with that they lost, well...
interest.
Yes. So where are we going to start? I mean, who's going to finance? My personal opinion is we can't get around that to say there is a need for public funding or support schemes. But let's follow up what the public thinks.
Thank you very much, Bas. To me, it seems like, I keep the microphone for a second maybe, for me it seems like geothermal is like the New York of infrastructure finance. If we can make it there, we can make it anywhere kind of thing. Because
at least in the renewables.
In renewables, it's definitely the case, right? Because you have basically a technology which on the one hand has a later stage risk. I mean, we can't really talk away that later stage risk? You know, how long will it stay hot, and is there a market for heat and things like that, right? There's a risk. And you have a fairly large early stage commitment necessary until you know whether you have a project in the first place, if you want, right?
Yes, and maybe to add on that, compared to the oil and gas industry, to develop a geothermal plant takes you maybe 8 years. Compare that with a gas combined cycle, where you develop and get it online in maybe 5 years.
Yeah.
So,
has anybody on my right side financed the geothermal project? You have? Bad example. Has anybody in the room financed a geothermal project?
Or been involved?
There's one in the back. Hallelujah. Thank you for being here. Maybe you can ask, we'll get to you, or tell us quickly what the project is. Yeah, now you have the microphone.
I will present this project this afternoon. We are a project developer based in Germany, but working in Africa. East Africa is one of the hotspots of geothermal at the moment. And we're working in Tanzania, and we are developing in the first stage, 10 megawatt power project in Tanzania. And we spent already about 2.5 million in developing this project, and we're looking at more funding and looking for investors here to go on. And I have to say that geothermal development is more, and it has been said, like oil and gas or mining. So you have a large upfront risk. But the upfront risk is for insiders not as bad. IFC did, for example, a study that 80% of the wells are successful, which oil and gas has not that track record. So we are pretty sure what we are doing, but the perception of that risk is the problem.
All right, thank you very much. Yes, please.
We have finance technical assistant.
I think it works now. Yeah. Could you switch micros?
Hello?
Yeah.
We have finance with sovereign guarantee some exploration under the assumption that it's too big a risk for a private sector. So some governments in Central America are advancing the exploration and then concessioning after finding the wells. And we are also working through financing of the Global Environmental Facility with the Colombian government in developing a risk mitigation policy for exploration.
Can I ask you, just on geothermal, I don't want to speak about geothermal technology predominantly here, but do you see a reason why to do that in geothermal, or how much of a case you need to have in order to argue for government to step in more for a particular technology than they would for other technology?
So far, I'm not a specialist. So far, what we are seeing is that if the countries that have developed it mostly have been developed with a public investment first phase, and there is no other success otherwise. So we have a lot of interest in Central America, particularly. We have a lot of hotspots there, and now we have a co-financing facility with the Development Bank of Japan. In concessional basis for co-financing the once you have founded the hotspot.
Bas, you wanted to add something?
Yeah, I'd like to add two things. I think that the technology makes perfectly sense. If I think about Central America, where we have certain islands which typically depend on oil imports to generate power. Now we know the raising cost and the burden on their financial household. And to add on as well, if you look at good papers from the IGA, the International Geothermal Association, nowadays there are certain models developed in different countries where there is, in one or the other way, a risk sharing between the private sector and the government. I'll give you one example. In Kenya, where the GDC is active, the Geothermal Development Company, they develop, so far I'm aware, with the governmental money, the steam fields, the green fields. Later on, the IPP can step in and say, okay, I built a power plant. But there are different models depending on the country.
I mean, you know, maybe just to make this clear, from our side, looking at the Swiss market, there's definitely a case for geothermal, particularly in the old villages where you can't where they have houses you cannot really renovate, so you need lots of heat, and that heat could come from geothermal sources. There's a good use for geothermal energy there. But as I said, let's not speak too much about geothermal, but speak about early stage infrastructure investment. Now we take a bit of a infrastructure plus real estate look from Raffaella, the Sipio. Raffaella is with a fund as well. If you introduce yourself
yes.
and get your
then
10 minutes.
I also have some questions, because it seems to me that we are speaking about early stage infrastructure financing, but outside Europe, because no one in the panel mentioned the issue of local vetoes. We do, yeah, but I mean, in terms of security of financing and rate of returns, the issue of local vetoes, especially, I mean, in Europe, it's a kind of quite significant bottleneck. Anyhow, coming to myself,
yep.
My name is Raffaella Di Sipio, as Nick told you. I spent more than 10 years in the energy and gas sector, being the licensing and regulatory affairs management director for two important multinational in the energy and gas sector, prior in Endesa, and then in E.ON, which is currently the biggest private energy and gas operator worldwide. And during this very large period, I developed a series of infrastructure, I mean greenfield infrastructure in the thermo traditional sector, so I mean CCGT or coal plants, but also yeah, coal plants. And I'm pro coal, I have to admit. Yeah. And also in the renewable sector, wind onshore, wind offshore, and PV parks. And for sure, in the last 10 years, funding this kind of greenfield traditional energy infrastructure was kind of easy in terms of situation of the market, energy price level, level of wholesale market competition. So these infrastructure were all full equity financed, so no debt on the infrastructure from the perspective of the energy player. Since February this year, I joined Prelios Group, which is a real estate fund, which is an asset management company, leading European asset management company, that it is also listed on the Italian stock exchange. And it means that also in terms of the things we are discussing now, bit of attention from the regulator, control from the National Bank in Italy. So we have binding limits to respect in order to enter also in the infrastructure sector. We do manage 23 funds. Two of them are strictly related to renewable sectors, for about 2 billion euros. And I joined the group as energy and infrastructure manager, just to start to develop infrastructure investment, also greenfield infrastructure investment.
So you're your own greenfield site, if you want.
Taking into account the limit that we have according to the nature of the real estate fund. But we are working, if we come to the bottlenecks, we are working with the governments of the nations where we do operate, in order to try to kind of overcome these limits and be able to enter into the sector of emission of long-term and short-term debt instruments. Also the sector of mini bond, which is quite new, I mean, at least in the perimeter of the Italian country. It has been developed at regulatory level starting from 2012, and now we have about 6 billions euros of emissions. And
could you tell a little bit more about the mini bonds? I mean, not many
it is an instrument of short-term debt that the government put in place 2 years ago in order to try to reverse the situation of credit crunch. If we look into specifically the Italian situation, because after 10 years of easy access to credit for businesses with a peak in 2011, then we entered into a credit crunch situation, and that was a problem especially for the renewable sector and greenfield infrastructure, also related to the parallel situation of regulatory framework with the continuous changing at European level, not only at national level, with reference to incentive schemes. This kind of short-term debt instruments is really helpful in order to support the development of greenfield renewable infrastructure, especially in the sector of the energy efficiency. So to me, the issue is that it is not really a problem of financing, especially at European level. It is more an issue that we have to change, I mean, the players in the game, because it is ended the time of big energy and gas players with equity and with no problems in terms of financing greenfield projects, even if I'm not sure I agree that the costs of the pre-development phase, if we look just Europe, it's only about 2 to 5% of the total cost of project, because if we think about local vetos, but also continuous changing in related regulatory frameworks, or the trend of re-regulation, I mean, the costs of the pre-development phase can be really more than 2-5% of the total cost of the projects. Same thing we can say with reference to the timing. You said 5 years or 8 years, according to different technologies. Again, maybe outside Europe, in Europe, also for little solar parks, PV parks, the licensing processes could be really time-consuming, and they do represent a real bottleneck. And so there, the issue is not if you are really able to finance the pre-development phase of this kind of little, let me say, PV projects, but the issue is to have specific agreement with local governments and national governments. I mean, not only in Italy, in trying to match also the needs of national and local strategic priorities, and also the economic needs due to the European-wide economic crisis situation. It is also important to try to match that priorities in advance, so that to have kind of official agreement in order to obtain within certain binding deadlines the for example, the licenses, but also for the zoning. The zoning may seem, I mean, a little problem. It is not a little problem if you have to face local vetos, and you have to face local vetos also if you want to develop pure renewable projects.
So the summary would be, it's not the technology, it's not the size of early stage commitment necessary, but it's really the government regulations that make it difficult.
Yeah, also, not only regulation, also political commitment. Yeah.
And the solution there is not an infra-ventures fund or a new facility, but the solution is what?
Yeah, the solution for sure is trying to have this kind of formal agreements with the local government prior to have the zoning and starting the land acquisition and starting the licensing procedure. Then venture solution is a solution. We did perform this kind of experience also in Italy with very little project in the energy sector, raising venture capital together with, in partnership with the financial companies of the regions, in a kind of official partnership with them. We were able to raise capital at national level, venture capital at national level for leader companies, I mean, with projects in the especially renewable sector, but not only virtual power plants, small energy scale, distributed energy, and it is not so difficult to raise finance, but then again, go to market, and in this case I mean go to market, obtain the license and the public consensus may be time consuming and very expensive, because we also have the issue of local compensation. I don't have experience outside Europe personally,
but in
but
Europe, that's a problem.
Issue of local compensation is an issue in UK for nuclear, in France for also for renewable projects.
But maybe let's stay on the topic of early stage investments and where the infrastructure investments and where the problems are. IFC mentioned that they kind of looked at the technology industry at Silicon Valley and they saw, hey, there's venture funds and they do early stage investments, so can't we do that for infrastructure? Is there something specific that you learned from the real estate space, where there's also lots of early stage investment going on, lots of building being built, that is sort of a parallel? Is there something like that?
Yeah, real estate can be, project finance, as I was trying to say before, I see really a change of, in terms of players in the game. So now in early stage financing of Greenfield projects, we see real estate funds as new players, real estate funds together with pension funds, life insurance companies are able to finance Greenfield projects and are interested to finance Greenfield projects, and establishing infrastructure dedicated funds, dedicated, I mean, to that goal. For sure, we also have the issue that the colleague was touching before. Normally investors do prefer to have a full authorized project prior to put the money on the project. But within this kind of special infrastructure fund, with project finance, with the experience of the real estate funds together with pension funds and life insurance company, we are now able to invest also in early stage development phase, and not only very close to financial close or mature infrastructure. But if we look to Europe, there are more business opportunities related to the divesting processes coming to traditional players. So a lot of capital is going to this kind of business and opportunities now, more than to new and greenfield infrastructure projects. Just to give you an highlight strictly related to Europe.
Yep, interesting. Before we have comments on these points, I'd like to audience, do you have questions now? This is sort of the follow-up points on a particular statement somebody has done. Yes, please. You just raise your hand, there's a mic coming. And introduce yourself briefly.
Yeah, sure. Fadi Khalil from Jordan Kuwait Bank. Actually, I will add something related to the government. I think the government should provide also the investor with the required incentive in order to move forward, like tax exemption or withholding tax exemption or something like that. In addition to get the required know-how to move forward, I think they have to get the required advisors behind or with the government itself in order to move forward with the project. You know that such project required a huge time from the government in order to know what is this sector, what is this industry, especially in the development countries like Jordan. IFC come to Jordan and the local lenders did not cooperate with them because the lenders itself, they didn't know what is the renewable energy, what is this sector. So the know-how required from also the lenders itself in order to move forward with such projects. That's my point also.
Please, Giridhar. Yeah.
Yeah, just to add to Fadi's point and also mention what Raffaella was saying, one of the lessons we learned after the first 5 years was precisely this point, that the governments just don't have the capacity to be able to negotiate these contracts, whether it's in a developing country like where we work, or in a developed market like the United States, which is actually quite far behind when you think about private sector participation outside of power. So what we are creating right now, we're in the next few months will be announcing a major trust fund that a foundation is going to be providing to us, and we're going to be raising some money for this, where when we start to engage on one of these projects, we want to have a trust fund that comes alongside us and pay for proper advisors to the government. And I think so if you just go back to the example I gave of the 50 megawatt hydropower project, which requires about $100 million of capex, on the developer side you may incur $2 to $8 million of project development expenses, depending on the market you're in. But on the government side, you're probably incurring about 1 to 1.5% of project costs, which is not capitalized anywhere in the transaction. And so here's the problem, right, if you're a government. If you are, just take a government, say in Africa, Cameroon. If we show up, or a developer shows up and says, listen, I have this great idea for a wind project, solar project, and I need you to go and spend $500,000 to go and hire a proper advisor out of London, legal advisor to draft a term sheet for a PPA, term sheet for a concession agreement. The typical answer you get from a minister is, I've had 20 developers here in the past 6 weeks. The Chinese were here the week before that, the Malaysians the year before that, or the week before that. Who do I go? If I spent $500,000 developing a term sheet for each PPA, I'd be out of money. So what you need is where a national PPP unit can play a role, and where we hope this trust fund can help us out, and other multilaterals can work with us. We just met some people at the IDB, is to say, when there is a committed and credible sponsor, credible developer trying to develop a project, can you get some trust funding to pay for the government's advisors at that time? Sending government officials to capacity building workshops is fine, but it's not going to help your specific project move. So I think there's a real need in the market, and that's sort of addressing both those points.
Somebody else wants to comment?
Exactly in the same line. A couple of years ago, Rio Tinto approached the government of Paraguay. They have a very large hydropower power plant. It was the largest before the Three Gorges was built. It's called Itaipu, and it's shared 50-50 with Brazil. And the deal basically was financed by Brazil, and it was repaid by electricity, but the repayment is ending, and Paraguay will be able to use the full 50% of the dam. So Rio Tinto wanted to produce iron and aluminum there, and they ask us basically exactly that. We don't know how to do a PPA. We don't know how to set the price in a 20-year contract. And they basically cannot, governments cannot afford to spend $2-3 million in project preparation in advance. And another point I will highlight that in Latin America is a big obstacle for, particularly for structuring PPPs, is that mainly all the procurement laws, in the public procurement laws, require the public officers to hire the cheapest price service, which is not the best way to go when you want to structure a deal. You want the best, not the cheapest.
Thank you very much. So governments need help as well, and you provide them a facility to get help. Before we go to a question over there, I just want to ask you to, if you compare on infrastructure with other sectors, like real estate, do you have similar situations there? Like, would you have a trust advising a government on a new real estate development? I think you don't really have it there, do you? Or do you? Because, and why don't you? So what's the difference between infrastructure and real estate? Or why does Rio Tinto not do a tender for the best advice, or go to Boston Consulting or McKinsey? Why do they need help, really?
My impression is that the real estate is a more mature market. They have private equity stakeholders, and they know the process. They have very good lawyers. They know how to navigate those waters. That's not here. In the case of the infrastructure projects, basically what you have is unsolicited proposal coming to you in a completely uneven field, and the government is not ready to play that game because it doesn't have the expertise or the capacity.
I'd add to that. I'd say 2 or 3 things. One is real estate is fairly, it's in the control of a local government. It's mostly about zoning, FSI, permitting, things that they're used to. If you look at a power project, especially for a developing country, there's a limited number of power projects that actually are developed for any country. The scale of these projects and the consequences of making a mistake are extraordinary. We're working on a project in Guinea, a very well-known project with Rio Tinto and Chinalco of China. It's a $12 billion project. It's 4 times the size of Guinea's GDP. Guinea is the Saudi Arabia of bauxite. And the famous incident, Rio Tinto showed up with 12 lawyers to negotiate a transaction with the government. The government had 1. And I bet that the lawyer was from the National Procurement Office. And if you're the...
Hope he was a good one.
Well, it doesn't matter as to whether you trained at the best law school in the world. You may not be familiar with market terms. And so the lawyer was paralyzed. And if I were the lawyer, I wouldn't sign anything. Because if I make a mistake in the next government, it's off with my head, literally. And so the consequences for messing something up are extraordinary. There's fewer projects, and so there's less of a track record of experience. And real estate is quite in the control of the local government. Even with renewables and all of that, European regulators are learning a lot about the consequences of the contracts, whether it's with interconnection agreements, grid stability issues, what this means for a budget, escalation clauses. So with newer technologies in developed markets also, you have the same problem.
Yeah, I think very good point. So you wanted to comment, sorry.
It's just very quickly, and then we can go to the questions. I think that what's very important is, as my colleagues have noted, is the regulation, the regulatory framework, yes, but also anything that relates to support schemes and grants for specifically now renewable energy infrastructure. I don't know if we have government officials in the audience. I wish we would. We're not talking about Europe, where we have seen that in the last 5-6 years that the market has boomed, specifically for renewable energy infrastructure. But we have to remember that not many years ago, 7-8 years ago, no bank and no private investor, no institutional investor would put any cent in this segment. And now we arrived in the latest year, despite the crisis, that we have hundreds of billions that are flowing into this market. And we owe that, again, I want to connect it to the private investor world, to some very visionary private individuals, private high net worth individuals that have triggered the initial investments in the technologies of the renewable energy segment, and then on a second stage in the renewable energy infrastructure. For exactly this and many more investors, the governments, not only in Europe, also in the growing economies outside Europe, should create the framework and the platforms to make it feasible, easier and quicker for such investors to take this leap of faith. And that's not only grants and support schemes, that's also legal framework, regulation and bureaucracy, measures to reduce bureaucracy, etc.
I guess that's true, but that also comes at a political price. Because then, you have to argue in Parliament that more money needs to be spent for this, that, and the other, because otherwise those schemes cannot be financed. So, I mean, the governments don't have unlimited pots, and I think we need to find another solution.
The governments don't have the experts to be able to do such stuff. And I'll give you a very simple, very short example. It's impossible that today in Greece, to bring you an example, we still have governmental funding for diesel generators on the islands, while we could have with 20% less cost investments and public money, renewable energy generation off-grid. So those are the examples that we see in many cases that the governments do not have the capacities, the expertise, the skills to create such platforms, to create the conditions to let the money come in.
Yeah, or the majorities to stop with the subsidies on the diesel generators, right? I mean, these are political decisions.
Well, in macroeconomically defaulted state, I think that should be the one priority, to save 80% of the public funding into energy generation on the off-grid.
Okay, thanks for that comment. There was a question from over here, if you may. I think, yeah, somebody who hasn't asked yet, yeah.
Thanks. My name is Tom.
Hi, Tom. Where are you from?
I happen to be a technocrat from government. The assumption that government don't have capacity is unfounded. I'm from Africa, in the city of Tshwane. But I want to, because what we are seeing, which is developing here, is that I think there's a challenge that needs to be raised, and that's some of these projects ought to come to us in an unsolicited fashion, making it difficult for us wherein there's a competitive law that says on a competitive-based scenario, which will be either appoint whoever, whether the price is low or no, but it's competitive enough, we're able to justify it. And that's why we say that if, for example, it comes through an unsolicited way, it becomes difficult for me to justify to the end users who must pay the full cost of this project as such. And that's why we're saying that it has to be understood in that context. But probably what we want to raise to the team is how will you suggest, or what is that you want us to take back to other governments in terms of ensuring that you are able to play your role? And I'll give an example. We went through a very painful exercise when we introduced our first PCAS or IPP in the country. And then when we bring renewable IPPs too. But we had to build that capacity of both the lawyers to negotiate with your international lawyers. Because we understood that the contracts need to be able to be bankable to your financiers and all those stuff. And that's the point which we're trying to raise, that in the scenario which you gave of Guinea, when there's no regulator, therefore it's a dictatorial tendency, you see? And therefore, and I want to be assumed that when there's no regulator, therefore we play by the rule of the financier. And we said, at whose interest? And it goes back to the question probably in the plenary when we're raising this too. If we were to use Bogota and use the one in Canada, which one makes sense? Because we then deal with the public interest issues in terms of bankability of the project as such. The last issue, it's on the project development cost. I think that we'll talk about it earlier, because that's the issue which I think we need a firm view in terms of say that for any project of this magnitude, which is what the question you raised, that what percentage or will you, if you, for example, you work on a 150 million, what will be the percentage which you must assign to that? Because I saw it, for example, when doing the PICA for the Department of Energy in South Africa. The price, the development cost spiral we started from our own thumb sucking, we end up at over 110 million rands, all those stuff continuing. But the question was because we didn't know what is the range of the brackets at which we must work around it, so that we can then be able to inform whether the investment decision we're making is in the best interest, and how do we then be able to factor it in the pricing as we go forward. Thanks.
All right.
Yeah, sure. A couple things. I think on the question of the unsolicited proposals, first of all, I would say that being a government regulator is a really tough job. It is not an easy job because you are accountable to the public and everything you do is under scrutiny. And the other difference between real estate and infrastructure is, as the gentleman pointed out, in the case of infrastructure, the government or the users have to pay, whereas in the real estate, it's all cash flow coming in. Yep. So, and it's just a variability in terms of how much cash flow you have coming in. So first of all, I think government officials in all countries have a tough job. I think that we learn by doing. In South Africa, we did the first concentrated solar power project in Africa overall. And I think if you were to go and ask a government official, the South African officials at Eskom and elsewhere, how much are they better equipped right now to go and do project number 2? Absolutely. And project number 2 is happening. So I think you learn by doing. The pilot ones. But I think the last thing is, and construction cost overruns are just a fact of life. I think that happens everywhere, and some sectors are more prone to that than others. Hydro is particularly notorious. But I think the last thing I would push back gently on is, you can't always get the best deal, theoretical best deal. You have to take a reasonable deal when it's on the table. At the end of the day, if you go to Contour Global, they developed the Contour Togo power plant, 100 megawatt power plant. Contour, or if you look at Bujagali hydropower project, 250 megawatt hydropower project in Uganda, it's on the Nile. The government will say, listen, the sponsor made too much money. but Uganda doesn't have power cuts anymore. At the end, and you delivered the low-cost source of power compared to what was to diesel and what was there before. So I think the tough thing for a government is to say, I have to take this deal when it's on the table. It's not the theoretical best, but you live to fight another day, and you get the next deal.
Can I ask you this? I think it's a very, very good and interesting point. In terms of the issue that was also raised, so unsolicited proposals versus tenders.
Yeah.
So I think, does everybody on the panel agree? You simply need to do both, right? You need to kind of enable the government to do for the strategic projects the tenders they need, but you also need to enable the government to make the choice among unsolicited project proposals and basically forward those. There's no right and wrong. There's no just only tenders and just only unsolicited.
So no, you do both, but in our experience, the largest, well, in infrastructure, it's empirically true, the largest source of cost is the EPC cost, engineering, procurement, and construction costs. So we always try to make sure that's tendered or at least benchmarked or referenced, even in an unsolicited proposal.
Yes, please.
Usually in Latin America, the unsolicited proposal have two stages. Once it's declared of in the public interest, then you have a tender. Yes. And the project developer has first refusal or some property right on the project and gets paid back if he doesn't win the... But so you have both.
Okay. Great, thanks for that. So there were more questions. Who had one over there? Yeah.
I'm Nebojša Arsenijević, based in Belgrade. I'm leading IFC's Balkan Renewable Energy Program. And if I may just add one important thing for InfraVenture, which is a very interesting product. So the cash that IFC is willing to put in such projects is just one piece of good things, because it came with IFC experience in project development and even more with indirect political risk mitigation, because if IFC is co-owner of the project, then we expect, it's not necessary, but we expect that public authorities that are issuing different licenses will not be so bad and ask for some additional money or something like that. One information interesting because you touch some geothermal projects, just one information that could be interesting. In Turkey, we have one project right now, geothermal Turkey. We are trying to create insurance product for geothermal, because in countries where you have a lot of potential projects and the interest is very high, this initial risk, and this is a drilling risk, is really high. Then if you have an insurance company interesting to cover this, maybe companies can recover whole or part of their initial cost if there is such mechanism to cover this risk. And you have invitation for next session in Sydney room to discuss about many risk mitigation measures, including regulatory, including Greek island. If you want, we can talk about that.
There are solutions coming. That's very good. Was there another question? No, we have oh, sorry. Yes, we go over there. We've got I'll do 5 more minutes after the, I extend to 5 more minutes, so we have 7 or 8 minutes left for everybody to know.
So just a very short remark from me.
Just your name, please. And
my name is Arnoud Walrecht. I work for KPMG. Bas, you put a question to the floor and you started to formulate an answer. And just to share with the room, in the Netherlands, there is actually a premium guarantee fund active for geothermal projects. So if it's the government setting up the fund, but you need to pay, as a project developer, you need to pay a little premium. And if you're running a risk of a miss in your borings, then you're paid out of the fund. So there is an example publicly backed already. Yeah.
First loss guarantee.
Exactly. Yeah.
Yeah. Okay, gentlemen. Thanks for that comment.
Thanks. It's followed on from the I think the comment the man from the IDC made. But I had another question for Raffaella.
Sorry, I didn't catch your name and your organization.
That's because I didn't say it. It's Jeffrey Smith from ING Bank.
Okay, sorry. Hi,
I've got a follow-on question, and then a follow-on observation, and then a question for Raffaella, if you don't mind. You're making the point that sometimes governments didn't have the expertise to argue their corner, but they didn't have the money to pay for the advice. And I agree entirely that not having advice means the government can be at a disadvantage compared with the the private sector. And of course, as a bank, I'm happy that they pay more for the advice and find the funds to do so. The danger, I think, is that we've got to make sure we address the right bottleneck in the chain, because I've worked on deals in Jordan as well, and one of the problems is even if you generously funded the advice, if the government can't afford to pay for the advisor, is not certain that the country could afford to pay for the project. And there's some real affordability issues that we suffered from. And although it's harsh and it's unfair, if you're a poor country who's trying to develop very, very quickly, you can't necessarily immediately adopt the same financing structures as you have in the UK and in the Netherlands. And the bottleneck's not necessarily getting the advice. The bottleneck might be you need to be just given the money for the project rather than borrow the money for the project from a Western bank. So that's my observation. However, my question for Raffaella, who's escaped with this throwaway remark, I couldn't help but notice you said earlier you were pro-coal, which seemed a brave comment to make at the sustainability. So without me saying whether I think that's a good or a bad thing, I thought it was only fair to give you the chance to expand on your pro-coal views at the sustainability
and I
conference.
salute you as the moderator, brackets.
It's a tough question if you ask me how to explain my being pro-coal in a view of sustainability investments. For sure, my being pro-coal is more strictly related to the costs of the resource, which makes the business model related to coal power plants really interesting for investors, also in terms not only of acquiring existing coal power plants, but also constructing greenfield infrastructure. So it's more related to the business model. It is also related to the base load capacity. Looking into Europe, it's not something that we do not know. It is not a surprise. The strong development of renewable sources, and so the consequences in terms of intermittency and the decision of some European countries to to abandon the nuclear option makes the issue of base load capacity, but also the issue of the the costs of investments in greenfield infrastructure a real issue. So, CCGTs are not in exercise wherever in Europe, in UK, in France, in Belgium, in Italy. A lot of CCGT are not in operation due to not only fall in terms of energy demand, but also in terms of gas prices.
Okay.
So,
maybe you can continue bilaterally. I would like to start a final round. Oh, sorry? Okay, last question, then final round. Okay.
Maybe to follow up also on what Giridhar said and on the GIB experience from the last 3 years, Global Infrastructure Basel has seen particularly this problem in early stage project financing, and we have written a scoping study on early stage project preparation fund, which was funded by the State Secretariat for Economic Affairs, which we are happy to share with you. I think it's particularly interesting to the participants here. And following on the venture capital approach, we are developing a fund which goes in the direction of a venture capital fund for the development of bankability studies, because as it was mentioned before, this is quite the focus. I hope, I think you will also maybe mention something.
My final comments is yours now, good?
Oh, okay, good, because I wasn't sure. So, but I think you will follow up also on this, and I'm sorry
so
if I
Global Infrastructure Basel is working exactly in this direction, so everybody should stay tuned to the GIB website. Stuff will be published there, and lots of tools already are available there, so have a look at that website. So just to wrap up, a very quick final round. I'd like to give everyone the word and start over on this side now. If you could just sort of, for you, key takeouts. Do we need a difference between different technologies? in infrastructure finance, so how much of a technology difference one needs to make, how much of a geographic difference one needs to take account of, and lastly, if we want to be sustainable in our approach for infrastructure, what specific issues emerge there? These are all big issues for a quick final answer, but try to just very much to the point, geographic differences, technology differences, and sustainability. If that's a focus, what changes there?
Yeah, from my specific point of view, I would focus on geographic differences and then sustainability, because more or less for the things I was saying before, looking to Europe, we have to if we have to focus on financing greenfield infrastructure, we really have to focus on where these infrastructures are really needed, right places, right technologies with financing. For sure, having finances, it's more easier if you are about to develop a project in the right place with the right technology. So the issue of technology is strictly related to renewable from one side or gas coal on the other side. And in geography, again, it's the same thing. Where you have had in the past strong renewable development, maybe you need hydro pumping storage more than new CCGTs, for example. And then for sure sustainability, because of EU directive on energy efficiency, because of the refurbishment that we have to apply also to existing infrastructure. I mean, in terms of not only power market, but also real estate market. So sustainability is really, I mean, a challenge for the future.
Thank you, Raffaella. Bas, very quickly from your perspective.
Yeah, I keep it short. I think in developing technologies, one should distinguish and one should develop the right technology at the right place. Again, for me, it doesn't make sense, and it's probably a strong statement, to develop power and heat solutions for geothermal in Europe, apart from certain areas where it's possible. Italy is one example. The rest, I would focus on heat, and I think our colleagues in the Netherlands are on the right way from that point of view.
Thanks, Bas. That was concise.
For us, the solution is more in the mix for energy infrastructure. We believe there's no one solution for each country. There's different regions where the one or the other technology makes more sense. On the financing side is creating these platforms and structures, either with mini bonds or early funds or companies like KKB Energy, in order to be able to address different risk-return profiles from the investor world and the financing. And before that even happens, before we even talk about early-stage development and financing, is having the governments, the decision makers, to create the field to facilitate such initiatives and ventures.
Thank you very much, Kostis. Gaston?
Yes, for us, I think I will split it in two. First and foremost, sustainability. I think every early stage financing vehicle should have sustainability standards to give the right incentive. And then, of course, geography and technology will vary by country. Some countries need some solutions and different technologies. I wouldn't pick the winners there.
Yeah, picking the winners, but there is a need for differentiating between geography and technology. Okay.
As far as the sustainability issue is concerned, we have our environmental and social performance standards at IFC, which we implement on every project. And I think we spend a lot of time with sponsors to talk about how addressing these environmental and social risks, these are the key operational risks for a project.
Exactly.
Otherwise, the asset's going to perform, for the most part. So I think addressing these ENS issues is very important from a risk management perspective. As far as technologies are concerned, I think gas, North American gas is now changing. Certainly Latin America, North America, potentially one day exports to Europe. We are going back into the hydro sector and trying to see if we can address some of the risks, particularly in Africa. Distributed generation will be important. We're seeing that solar and wind are viable in these markets, and I think this is the key thing, which is that whatever market we go into, we try to be the low-cost source of power. And if you're going to create a baseload power project, and I think you're seeing that solar in many parts of Africa, compared to where diesel is right now, it's viable, unsubsidized. So I think these kinds of going in with renewables will make sense in different kinds of markets.
True cost accounting needed, but if so, then
even then, I mean, even then, you're seeing solar PPAs being signed in Chile for 12 cents a kilowatt hour.
That's
that's obviously very good solar resource over there. You're seeing, so it's viable in Africa. In the Caribbean. I mean, in the Caribbean, there are islands which pay 50 US cents a kilowatt hour for diesel.
Okie doke. On that happy note, I'd say, I'd like to close this session. Thanks everybody for being here. As I mentioned, GIB is active in this space. We have very relevant parties involved, so stay connected to GIB and let's get more sustainable infrastructure finance rolling. Take care, everybody. See you later.